accounting equation is what? What is it? No, I don't want that. I want to know what's the equation.
Assets equals liabilities plus owner's equity.
Yes, that's assets equals liabilities plus owner's equity. Good.
That is engraved in my brain.
There it is, ingrain it in your brain. I bet students who sent me notes later and they signed it. Assets equals liabilities plus. Never forgot it. Okay, so the entire process is going to be, we're going to analyze our transactions and say what's happening to the business as we get these, do the transactions or spend money or buy stuff or like we've talked about. And we're going to look at how it affects the equation, right? So, and we already know this, right? If two parts are known, we can solve for the third, which is what you did for your homework. Okay. Okay, so let's look at some equations. We've already looked at the assets, where we bought assets and sold assets, right? And where we paid on accounts payable, created accounts payable, right? Created accounts receivable, bought supplies. So we've done that. So let's look at what happens when we start operating our business. And what we hope we get is revenue, right?
Absolutely.
Revenue. Revenue is the inflow of money or other assets that come into the business as a result of our operations. So,
what could be an asset that comes in? What could be an asset that comes in with revenue that's not money?
Not money? Accounts receivable.
Oh, okay.
Huh?
Well, I think of that as money. It's just not there yet. Okay.
Doesn't come in as a result of revenue. Revenue is a result of sales. So somebody might want to pay you in bartering.
And chickens.
What's that? What'd you say?
I said in chickens.
Free chickens. Yeah. Give me a chicken. Eggs. Well, we
Hey,
don't
that's
pull them out.
So, now, really seriously, if you had somebody that did that, how would you keep the books on that?
You would show eggs coming in, I guess.
Would it be market value for the eggs? Is that what you?
It'd be whatever if you told them you'd take 2 chickens for working for them for 2 hours.
For $5 or whatever. I got it.
You'd show your revenue, right? Yeah.
But whatever your agreement with them is, the eggs would be worth that, and that's what you'd show on your books.
Exactly. Yep.
Okay. Got it.
Eggs
Thank
are
you.
not a good example because you're going to eat them. Then you have to show your eggs going right.
I didn't mean to throw us off there, but I just didn't understand it.
That's okay. That's good. Okay, so revenue is something coming in, right? Inflow into the business? Yeah. Well, then what's an expense? Read your book, read your lesson. What's an expense?
An outflow of cash.
Money going out. Okay, money going out to do what?
Buy something for the business.
Operations.
No, that's right.
Operations.
That's right.
Okay, to do what?
Pay a bill.
To operate the business.
For that.
Expenses or operations of the business. Actually, it is to buy something if you're not creating a debt. Sorry, but it is.
Okay.
If you're buying equipment or something, that is a transaction. But it's not an expense because you're purchasing an asset. So,
Right, it's going to help
going
the
back,
business.
it's going to be an outflow that is necessary to run your business, just like if you go home, what do you have to have in order to live? And that's your business operations expenses.
My bed and cable.
Cable and bed.
So her bed
And
would
the
be
air conditioner.
equipment and your cable expenses. Yeah.
Yeah, gotta be. It's the outflow of cash or other assets, or the incurring of a liability in order to keep your business going, like, and incurring that liability. This is not actually a liability in the sense of a long-term liability or something that we bought something for. This is like if your electricity bill comes in and you get that account, you have to pay it and pay it later. Okay. For the operations of the business. Okay. So, okay, we're in business, and we've received $36,000 in cash for services provided to clients. Yay. So, $36,000 came in. What is it? What did we get? We're analyzing right now. What do we get?
Revenue.
What did we get, okay, on the left side of our equation? What did we get?
First we got cash. Sure, we got
We got an
cash.
asset, right? We're going to get something for our work, so we've got to get an asset of some kind.
We got cash.
We got cash. Okay, so we received cash plus $36,000. Okay, right? Okay. Then, is our account in balance if we don't do anything else?
No.
No. All right, so
No, it's
what we're doing, and this is very important. This little concept here is very, 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 very important. All right. Carolyn Wells is sitting here with $100,000 in her equity or her capital account, right? We've been figuring that. She bought stuff and that's how much she's got invested in the property and everything that she owns. Now, we're operating the business. And so as we operate the business each month, we're going to have a section of equity, actually. But we're going to keep up with it separately. It's going to be another account called revenue, another kind of account called revenue. And it's part of equity in that it's income coming in that she earned, right? So we could actually, if we didn't, if she didn't have any expenses or anything, and we were just not going to do a statement at the end of the month, we could just go ahead and throw it into her equity, couldn't we? She earned it, money came in. It's the same thing as if she went to the bank, got money, and put it in cash, right? Essentially.
Yeah.
All right. So we're going to keep up with revenue separately until the end of the month. So we know how we're doing. We want to know if we're making money. And we want to, at the end of each month, we want to do a profit and loss or an income statement. And so when we do that, we're going to show everything that came into our business as revenue over here. Right? Everything that went out as expenses also show up in a separate section over here as part of a reduction in revenue, right? And then at the end of the month, we're going to take our revenue, subtract our expenses, and whatever we had as net income. Then we can put it into the capital account. The difference between the revenue and the expenses. Okay. Right now, all you need to know is we're going to keep up with revenue separately as part of the equity over here, but in a separate account. A type of account, classification of account. Okay. So we're still in balance, right? All right. For the moment. Okay. Now, we're still in balance. Yeah, we are. Now, we performed some more services, and we got $11,000 on account. What does that mean?
Sold something on the credit.
We didn't get the money yet, so what kind of account is it?
accounts receivable.
Accounts receivable. Yes, because we're going to receive money, right? And we're assuming at this point that they're going to pay us. So it's the same as cash, just means we're going to get it later, right? All right. Okay. So far, so good? We added it to our revenue up here, didn't we? We have a new asset account called accounts receivable.
So when you get some of that accounts receivable in, it would subtract from that and
Add what?
it would subtract from account receivable
And add to,
cash.
that's right, because you're getting cash, right? So accounts receivable, in essence, is same as cash.
So you don't
It's
really
just
have to,
delayed cash, we could call it. Delayed.
It's out of the other book. It's out of the 12th edition.
I was just going to say.
Why would you do that? Okay, I want you to think about it. So I'm not being short. I'm just saying why. Okay, I want you to think about it. I want this. This is a very important concept because just what he just said is the very thing that a bunch of you are going to do. you're going to think when you get paid for that accounts receivable that you're going to have to add it to revenue. Why would you not? Because you already have. But that's a mistake. That is a common mistake. When you receive, if you'll see in your transactions, received money on account
Her book, she's on page
or from accounts receivable. It's going to be very tempting to go, because you're thinking, sales, revenue. Not revenue. It's already, we've already shown the revenue, right? So all you're doing at that point is changing it from cash that they owe us to cash that we got in the bank. That's all you're doing. All it is exchanging the type of asset. That's very, very important. I'm glad you brought it up. Because I guarantee you, when we do some of these things, some of you are going to. So just remember that. I'm not going to, and don't do it. And remember that it's not new revenue. It's simply money that they owe us and they're paying us. Good deal. Okay. So far, so good? Okay, we're going on. Here we are. Yes, it happened. You got paid some money that they owed us. So what happened?
Debited accounts receivable, debited cash.
Right. What they owe you went down, and your cash went up. Assets stayed the same in total, right? Okay. Everybody okay with that? Everybody got it? Nothing changed. You just got your money in your bank, which you're hoping you get.
From one to another
From one to another, that's all.
is all your.
That's all. Except you do have money in the bank now.
Yeah.
Which is good. That's a good thing.
It went
Okay.
from non-spendable to spendable.
Yes, exactly.
Yeah.
Exactly.
I like that.
Exactly. Okay. Let's keep going. And we stayed in balance. We paid out salaries for the month, $8,000. Okay. So this is money going out to operate our business. So since it says pay, anytime it says pay, then you know you got to take it out of cash, right? That's one part of your. You'll notice that there's two parts to every transaction, right? There's two parts to every transaction. What's that? Okay.
And it seems like you're giving more than you're getting.
Yeah, or just changing around an asset, right? Changing something. So there's two parts. Because we must at all times keep our equation in balance. So two parts. Here's one part. If this side of the equation went down, what has to happen on the other side of the equation to keep it in
It
balance?
has to go up.
It has to go down too, doesn't it?
Yeah.
So over here, we're going to keep up with another column, expenses. What they're showing is they're showing revenue minus expenses, but as you're adding your expenses in here, they're going to show it as a plus because what it's doing is increasing the amount that you're accumulating as expenses to subtract from your revenue. Okay. So don't let the plus sign fool you. When you get down here, you see the total is going to be subtracted from revenue. And that's what keeps it in balance. Okay. I don't like this, but as soon as I get one, I tell you what. I'm gonna, if it'll let me. See, I haven't. No, it says it's not gonna let me. Okay, never mind. I've been unable to edit these things to make them like I want them. Could just make them slider. I might just do that. Anyway, is everybody clear though? What you're doing is you're increasing what's going to be subtracted.
Right.
So you are staying in balance. Okay. Last slides do the same thing. Okay, we're in balance. Yay. Oh, utilities expense. I'm just going to go through these because we're doing the same thing. Another expense coming out of cash, increasing our total expenses. All right. Then, okay, she decides she needs some money. She's getting short of money. She needs some money. Now, in a sole proprietorship,